International Conference on Accounting and Finance.
Good afternoon, all of you. I am here to give presentation on the topic Finding Behavioral Gaps in Market Paths. This paper has been co-authored by Dr. Renu Verma, Faculty IBS School, Gurgaon, and myself, Sheena Manchanda, doctoral student, Jagannath University, graduated in economics from Shriram College of Commerce, Delhi University, completed MA Economics, MBA Finance, PGD Finance, various certified programs and research papers in finance, worked as Assistant Professor in Jagannath Institute of Management Studies for 23 months and then worked as guest lecturer in various premier management institutes. Then started my own institute, currently pursuing PhD. Behavioral finance overpowers fundamental analysis and then conclusions and recommendations. Starting with the introduction, the ups and downs in the financial markets are always in news. Wide price fluctuations over world stock markets are a daily occurrence as investors react to political, economic and social events. Markets have been showing erratic movements which are in no way tandem with the information that is fed to the markets. Indian stock markets, they have quickly transformed themselves into gambling dens where speculators are overtaking the individual investors. Indian stock markets display greater volatility over and above the fundamental reasons. This has given sleepless nights to a lot of investors as well as market regulators. Irrational exuberance has substituted financial prudence. The speculative money has no rational behavior. Now, talking about the objectives of my research paper, the paper tries to answer the questions: has the Indian stock market volatility increased? Has the Indian market developed into a speculative bubble? Why is this volatility so pronounced? It tries to capture and examine the movements in the market beyond the expectancy of logical dimensions under the purview of fundamental analysis. Further, it identifies the various factors causing volatility to increase to exorbitant levels. Then it tries to unearth the rationale behind these weird movements, and it also intends to analyze the determinants of individual investor behavior in the Indian stock market. And here in my research paper, we have introduced a new concept of behavioral gaps. So I will explain it further. Now, talking about the research methodology, the research is based on secondary data, and we have reviewed various research publications and working papers. The paper is theoretical as well as empirical in nature, and we have taken period of 2008 to 2013 of Indian market data and analyzed it with the help of application of technical indicators. Now, journey from EMH to BF, that is from efficient market hypothesis to behavioral finance. Efficient market hypothesis maintains that market prices fully reflect all available information. Now, this hypothesis has been extensively applied to various theoretical models and empirical studies in the financial market. It was developed by Paul A. Samuelson and Eugene F. Farmer in 1960s. According to the economic theorists, here investors think and behave rationally when buying and selling stocks. In reality, they do not. That is why the critique comes from psychologists and behavioral economists who argue that EMH is based on counterfactual assumptions regarding human behavior, that is, rationality. So this led to the emergence of the field of behavioral finance. Behavioral finance is an emerging science and a developing field of academic study that exploits the nature of irrational investors. It attempts to explain and understand that how investment decisions are influenced by the prejudices and perceptions of the investors which do not meet the criteria of rationality, and further how emotions and cognitive errors can influence the investment decision making power. That is why we can say that the ultimate shape of the market is governed by behavioral finance. Behavioral finance overpowers and dominates the fundamental analysis, and that is why we are calling the market movements beyond the fair scales, which are under the purview of fundamental analysis, as behavioral gaps. Now, what is this behavioral gap? Behavioral gaps are defined as the movement in the market which are beyond the expectancy of logical dimensions under the purview of fundamental analysis. That means these are those market movements which cannot be explained by fundamental analysis, which are the result of behavioral finance. The presence of these behavioral gaps divides the total region in the market into two parts, efficient as well as inefficient region, which I would explain one by one with the help of this diagram. Here we can see that the dotted region on both the ends is the inefficient region. It captures and examines all the market movements which are not supported by fundamental analysis. That means these are the result of behavioral finance. These are the basic results of the principles of the behavioral finance and the various factors, those come under the purview of behavioral finance. Whereas the red lines on both the ends, these are called logical boundaries. These have bounded our efficient region. The efficient region captures all the market movements which are the result of fundamental analysis. Now, crossing the logical boundaries on both the ends lead to the formation of behavioral gaps. The shaded region, green ones on the upper side and red ones in the downward dotted region, those are our behavioral gaps. Now, what are the reasons behind gaps? I have already stated that the basic reason is behavioral finance. And under the sphere of behavioral finance, basically we are pinpointing that the investor psychology is responsible for it, which has a bigger role to play since it marks all the turnarounds in the equity market. Individual investors, they do not behave rationally. They are basically misled by the extremes of emotion, herd mentality and subjective thinking. Now, one of the basic reasons is the presence of anomalies. Anomalies are termed as preference reversal and the apparent violation of transitivity, that is logically inconsistent choice, and these are further catalogued as violations to the 15 principles of rationality that has been given by Richard Thaler in 1987 in Mainstream Economics. Other than anomalies, we have emotions, which play a very significant role. Emotions interfere with rational decision making. Now, it is the expectation of the investors which make the investors behave emotionally. So, ultimately, expectations and thereby your emotions, those are dictating the market and those are deciding the market integrities as well as deriving the asset prices in the financial market. At the aggregate level, emotional crowds, they decide the directional movement of the market. They determine the price as well as volatility, with fundamentals playing a small role. Factors behind gaps. Now here we have pinpointed all the factors behind gaps. In the first category, we can talk about the emotional mistakes those investors commit, ranging from overconfidence to cognitive dissonance in influencing economic behavior. In this, we have underconfidence, loss aversion, and imperfect understanding of probabilities or statistically incorrect incorporation of new information. In the second category, we talk about the role of the society, where we have group thinking, social emulation, social learning, social influence of peer pressure. And then we have two basic emotional reactions, which are sensitivity to losses and gains, and greed and fear, which are contradictory approaches. And in the fourth category, we talk about psychological biases like overreaction, underreaction. All these in the fourth category, they are closely knitted to each other, they are interconnected. For example, conservatism and representativeness heuristic leads to underreaction and overreaction. And further, we have constraints like memory constraints, heterogeneity of investors, different trading attitudes, impact of analyst coverage, etc. Now, here we talk about the empirical analysis of the Indian stock market. Now, the decade 1998 to 2008 saw a great momentum in the investment scenario of Indian financial market. There was an unprecedented spurt in the volume of the trading exchange of India, in the spot exchange as well as over-the-counter exchange of India. People just chomped into the market with the little savings they had, and without recognizing the risky element that was there in the underlying securities. So overall, this led to an over time remarkable shift from rationality to irrationality in the investment behavior. They overlook the need to understand the fundamentals, and most of the investors, they just rely on suggestions and opinions. So basically it is the psychological factors which deviate, which helps in driving the prices away from their fair values and lead to excess volatility. So overall we can say that behavioral finance shadows the importance of fundamental analysis. And in order to prove this, we have taken period of 2008 to 13 to understand the financial market paradigm shift over time. And this period we have analyzed with the help of application of technical indicators. Now technical indicators, which comes under the purview of technical analysis. Now technical indicators, they help us to visualize excess volatility as well as the formation of behavioral gaps. Now we have a number of technical indicators like EMA, exponential moving average, Bollinger Bands, relative strength index, then stochastic relative strength index, Williams percentile, MACD, which is moving average, convergence and divergence. All are written in the second point, but we have focused on basically 4 indicators: exponential moving average, stochastic relative strength index, commodity channel index, and Williams percentile. And we have taken period from 1st of April 2008 to 31st of December 2013. And here in the graph we have taken weekly closing prices of S&P CNX Nifty, that is index of National Stock Exchange of India. On the x-axis we have time period, and on the y-axis we have all the values of Nifty, and here we have taken the price line chart. Now in the first box we have the price line chart, which is superimposed with the upper indicator, that is exponential moving average. So here exponential moving average of 20 days is the red line, and of 50 days is blue line. This is the upper indicator because this is superimposed on the original price line chart. Now the more the deviation of the exponential moving average from the original price line indicates that there is presence of excess volatility in the market. So this basically indicates divergence in the market. More importantly, our focus is on the lower indicators, which are stochastic RSI, CCI and Williams percentile. Now lower indicators are those indicators which are shown over a particular range or scale. And all these indicators which would help us to identify the formation of behavioral gaps, which are shown in the graph, green and red shaded area. Now talking about stochastic RSI is a technical momentum indicator which helps us in identifying the overbought and oversold positions in the market. Now it ranges, currently we take period of all over across the countries. 20 to 80 reading is used. Traditionally 30 to 70 reading was used. Now stochastic RSI is an oscillator. This is an indicator of indicator, and it signifies the relationship between the relative strength index and the high-low price range over a specified period of time. So when your stochastic RSI approaches 80 and crosses the 80 level, an asset is deemed to be overbought, and that becomes a good candidate for pullback. So it might be getting overvalued. And on the other hand, when your stochastic RSI is touching and crossing the level of 20, an asset is deemed to be oversold and it may be getting undervalued. So the overbought and the oversold positions helps us in identifying the formation of behavioral gaps. Secondly, the CCI, commodity channel index, which is an oscillator, and here we can identify the overbought as well as the oversold positions, and CCI has gained substantial growth and popularity. This is widely used by technical analysts, not only in commodities but in equities and currencies as well nowadays. That is one of the reasons that we have used CCI. Now CCI quantifies the relationship between the price of the stock, moving average of the stock, and the normal deviation, that deviation that is there between the price and the moving average of. Since it also identifies the various overbought and oversold positions which are leading to the formation of behavioral caps on both the ends. And thirdly, we have Williams percentile, which was developed by Larry Williams, and it quantifies the relationship between your stock price relative to high-low price range over a specified period of time, which is generally taken as 14 days. It is also a technical momentum indicator, and here also reading that we are using is 2080 to identify the overall overbought and oversold positions in the market. So we could see in the graph that behavioral finance ultimately dominates the basic sphere of fundamental analysis. In our paper, we have gone through numerous empirical evidences from Indian markets in order to support this equation, and it can be any of the fundamental factor which is exaggerated by the presence of behavioral finance, like government policy, FI flows, elections, poor monsoons, etc. So conclusory remarks: behavioral finance changes the way we should look at the markets. It changes the angle of perceiving the market, the angle of analyzing as well as interpreting the capital market performance. And most investors display emotional incapacity to deal with market situations. And even the active investors, though they use all kinds of strategies and analysis, but still they are subjected to behavioral heuristics and biases. So there is a need to educate and counsel the investors. More and more awareness programs, education seminars should be there, so that we can make our investor as a knowledgeable investor. He should be aware of all the principles of behavioral finance. Behavioral finance does not offer investment miracles, but it can definitely help to train investors to be watchful of their own behavior, so that they can commit lesser and lesser of emotional mistakes in the market, so that if individuals master their emotions and they save them from the traps of behavioral caps in the market paths, we can make our market convergence, converge towards the path of efficiency. At a definite level, perfect market efficiency cannot be achieved, but by following these recommendations, we can try our best to increase the market efficiency in the financial markets across the country. Thank you so much.